So it's been a fascinating few months because at one point the market was up, I think, around 10% on the year, very early in the year, and then it's given almost all of that back. People were kind of talking, like things could only keep going better. And then boy did things change at the end of January. Interest rates started to move up, and that really kind of spooked the markets. Very quickly at the end of a very strong January, the market started to reverse, and really the last piece of that would be volatility. We saw volatility which was very, very low to end 2017, early 2018, and then volatility came back sharply. It continues to be a very good environment for dividend growth, both in the markets overall and specifically in our portfolios. And the reason for this is the dividend growth tracks corporate fundamentals. And so what we're seeing right now is that the global economy is doing pretty well. And so corporations are doing well. Their revenues are up, earnings are up, and that means profits are up, and dividends get paid out of profits. And then there's actually a second dynamic at play, which is the tax cuts. So one of the impacts of the tax cuts is that by reducing the tax bills that companies pay, it means they have more after-tax net earnings and more cash to pay out to shareholders. So you combine a pretty strong, fundamental economy with a boost from the tax cuts, and it sets the stage for a good year of continued dividend increases. That said, we are doing things to reposition the portfolio a bit. We always do things with a long-term focus, so there's some tactical shifts, but not a change of long-term strategy. And the tactical shifts I think you'd see is that on the buy side, we're looking to add a little bit more interest rate sensitivity to the portfolio. So in the financials, we've added a bit to the banks where if interest rates rise, the banks should benefit. And then the second piece would be adding some inflation hedges in the areas of commodities. We're looking at that. We haven't done anything there yet, but that's something that we're thinking about and trying to factor into our portfolio construction. In terms of what kind of names are we reducing, on the margin we've reduced a bit of our consumer staples exposure. We continue to like our better growing staples, but we had one or two staples where their investment proposition was a little bit more about current yield and a little bit less about growth, and I think we're tailoring those positions a bit. What seems very clear is that for a whole host of reasons, both economic and otherwise, the world seems to be a more uncertain place presently than it has been for quite some time. Amidst this backdrop of uncertainty, we really like our portfolio. Our companies have really strong balance sheets. They're large, they're well capitalized, they are generally less cyclical and have more predictable and stable revenues, and they pay nice dividends that we expect to grow over time. And we think that whatever path unfolds in front of us, our companies are well positioned to navigate that.